Hey everyone, my name is Farhan. Today here we have three questions for depreciation. You'll see the questions on the left hand side of your screen, and on the right hand side you'll see the workings, which I'll explain step by step. So let's start with the first question. A business purchased a motor car on 1st of July 2009 for $20,000. It is to be depreciated at 20% per year on the straight line basis, assuming a residual value at the end of 5 years of $4,000 with a proportionate depreciation charge in the year of purchase. The $20,000 cost was correctly entered in the cash book but posted to the debit of the motor vehicle repairs account. So what we can understand here is that the cost of the non-current asset, the purchase of the non-current asset, has been incorrectly treated as an expense, which is an error of principle. Now, how will the business profit for the year ended 31st of December 2009 be affected by this error? All right, so let's look into the workings on the right hand side of your screen. So we know that we have an error of principle, and the reason this is an error of principle is because we have shown the purchase of non-current asset as an expense. Now, this means that we have understated our non-current assets by $20,000, which is the cost price involved in this question. Now, when the cost of the non-current asset is understated by $20,000, it is logical to say that we will also understate the depreciation, because in the books we haven't included the cost of the non-current asset of $20,000, as a result of which we will fail to calculate the depreciation as well. Now, what was the depreciation expense for this non-current asset, for this new non-current asset that we have purchased? The depreciation expense would be calculated by taking the original percentage of 20 and multiplying it with the difference between the original cost and the residual value. This is the basis of finding the depreciation when you are using the straight line method, which is simply to apply the percentage with the difference of the cost and the residual value, which is also known as the scrap value. Now, you are also multiplying 6 by 12 at the end. And the reason we're doing 6 by 12 is because we know that this asset was purchased on the 1st of July 2009, and we are finding the profit on 31st of December 2009. Based on the company policy, we are to charge a proportionate depreciation in the year of purchase. So if the asset was purchased on the 1st of July 2009, and given that we're finding the profit on 31st of December 2009, we have 6 months in between 1st of July and 31st of December, which are the months of July, August, September, October, November, and December. All right. Now, we have 6 months altogether, and therefore, out of the total 12 months in a year, we are utilizing this asset for 6 months in the financial year ending 31st of December 2009. And that is the proportionate charge for depreciation that we're including here. So 20% that we have been provided is an annualized rate, which the question specifically mentions 20% per year on the straight line basis. So therefore, we must make sure that we are proportioning the depreciation for 6 months. So altogether, the answer comes out to be $1,600 for the depreciation expense for this purchase of non-current asset. Now, because we have failed to include the cost of the non-current asset in the books, therefore we will also fail to include the depreciation expense that we would have incurred. And that amount is $1,600. So in the books, we would be understating depreciation expense by $1,600. Okay? Now, let's move on to the repairs expense. Now, repairs expense is overstated by $20,000 because of the error of principle that we have made, where we have shown the cost of the non-current asset as an expense. So if the repairs expense is overstated by $20,000 and the depreciation expense is understated by $1,600, the total effect of both these mistakes would be that total expenses are overstated by the difference between $20,000 and $1,600, which is $18,400. So why is this overstated again? Because the mistakes that we have done, you can see that the mistake in the overstatement is more compared to the mistake in the understatement, because we have overstated the repairs expense by $20,000 when we have understated the depreciation expense by $1,600. So the net effect for both these mistakes comes out to be 80,400 for the total expenses being overstated. Okay? All right. So if total expenses are overstated by $80,400, then profits must go down. So profits are also therefore understated by $80,400. So profits are understated by $80,400, which is option A, and that is the correct answer to select for question number 1. Okay? All right. So let's move to question number 2 now. The planned account of a company is shown below. So here you can see we're given the ledger account or T account of plant, and we're given the cost balances here. The company's policy is to charge depreciation on plant at 20% per year on the straight line basis with a proportionate depreciation in years of purchase and sale. What should the company's total depreciation charge be for the year ended 31st of December 2009? All right, so let's look into the ledger account that we are given. And because this is a non-current asset account, which is the plant at cost, we know that all purchases of assets and the opening balance of asset are to be reported on the debit side, and all disposals of asset and closing balance of asset are to be reported on the credit side. So let's look into the debit side. So we know that on the 1st of April 2009, we have purchased a new plant using cash, and the cost of the plant that we have purchased was $51,000. Okay, so let's start with the purchase of this new plant first. So we know that the new plant was purchased on 1st of April, and the original cost was $51,000. We are calculating the total depreciation for the year ended 31st of December 2009 based on the requirements given in the question. And the question also explicitly mentions that we are to apply proportionate depreciation in the years of purchase and sale. All right, so if I want to find the depreciation for this new plant that we have purchased, we know that this plant has been bought on 1 April. Therefore, the depreciation that we will calculate is from 1 April until the end of 31st of December 2009. Okay, and we are using the straight line method, so we simply apply the percentage that we're given, which is 20, with the original cost of 51,000. All right, in this case, we're given no residual or scrap value, therefore we have nothing to subtract. And then we multiply 9 over 12, which takes care of the proportionate charge. Because as we understand, from 1st of April, the day the plant was purchased, all the way until 31st of December 2009, we have got 9 months in total, right? So we've got April, May, June, July, August, September, October, November, and December. So we've got 9 months in total. So therefore, 9 out of 12 is the proportionate charge here. So altogether, the depreciation for this new plant is $7,650. Okay? All right. Now let's look into the disposal of the plant that we have done on the 1st of April 2019, which is what you can see on the credit side of the ledger account. The plant that we have disposed had a cost of $30,000. And based on the requirements of the company policy, we know that even in the year of sale, we are to apply a proportionate depreciation. Okay? Now, we know the original cost of this plant that we have sold on the 1st of April 2009 is $30,000. So if we are selling this plant on the 1st of April 2009, then we know that this plant has been used for 3 months in 2009, which are the months of January, February, and March. Okay? So the depreciation in this case is calculated as taking the percentage, which is 20, multiplying with the original cost of 30,000, and then multiplying with 3 over 12, which is the proportionate depreciation charge for the 3 months that this plant was used in the year 2009, which are the months of January, February, and March. All right. So the depreciation for this plant that we have sold is $1,500. All right. Now, what do we have in terms of the remaining plant and equipment, the remaining old plant and equipment? So you see, we started the year with $380,000 as the original cost that we had in the books. Okay. And if we were to exclude the new purchase of plant and subtract the disposal of the plant, of which had a cost of $30,000, then we know the remaining plant and equipment, the old plant and equipment, would have been $380,000 minus $30,000, which is $350,000, right? Okay, so how do we depreciate this? Remaining old plant and equipment, we understand that this old plant and equipment, because it's remaining in the books, it means that they have been used for the entire financial year in 2009. Therefore, the depreciation is simply calculated by multiplying 20% with 350,000 for the remaining old plant and equipment, which is $70,000 altogether. So the total depreciation charge that we have got is therefore $70,000, which is for the remaining old plant and equipment, plus an additional $1,500, which is the depreciation for the 3 months of the plant that we have disposed during the year, plus an additional $7,650, which is a depreciation for the new plant that we have purchased on the 1st of April and have used it for 9 months. So altogether, the total depreciation charge in this case is $79,150, and therefore the correct answer to select in this case is option B. So therefore, for question number 2, the correct answer to select is option B. All right? Okay, so I believe that is clear with all of you. Now let's move to question number 3. Beta purchased some plant and equipment on 1st of July 2009 for $40,000. The estimated scrap value of the plant in 10 years' time is estimated to be $4,000. What do we understand by the scrap value? Now, the scrap value or the residual value refers to the likely amount that we can get after the plant or the asset has been fully utilized within the business or has been fully depreciated. Then all the economic benefits which has been consumed. Afterwards, the only value remaining is $4,000, which you can get by getting rid of this plant. Beta's policy is to charge depreciation on the straight line basis with a proportionate charge in the period of acquisition. What should the depreciation charge for the plant be in Beta's accounting period of 12 months ending 30th September 2009? Right, so we are calculating the depreciation for an asset which we have bought on the 1st of July 2009, and we paid $40,000 to buy that. All right, how do we depreciate this? Okay, so in this case, this is also a straight line method. We find the depreciation by finding the difference between the cost and the residual value, or the cost and the scrap value, and then dividing it with the useful life. All right. So the cost is $40,000. The scrap value is $4,000, which I'm subtracting from the cost, and then I'm dividing it with the useful life of 10 years. And then, because we know we apply a proportionate charge in the year of acquisition or in the year of purchase, we're multiplying 3 over 12, which means that this plant has been used for 3 months. And those 3 months are July, August, and September, because we're calculating the numbers on 30th of September 2009. And given that this plant was bought on 1 July 2009, this plant has been used in the business for 3 months, which are July, August, and September. So the final answer in this case is $900 once you've done all the calculations, which is option number C. Option C. Okay? All right.